Ever wondered how to make your investments work harder for you? Well, allow me to introduce you to the concept of dividend reinvestment plans, also known as DRIPs. They're a powerful tool that can help maximize your investment returns, even when you're not actively trading. Imagine if, instead of receiving dividends as cash, you could put those dividends straight back to work. With DRIPs, that's exactly what happens. Your dividends are automatically used to buy more shares or even fractional shares of the same stock directly from the company itself. It's like planting a seed from a fruit tree instead of just eating the fruit. The seed grows into another tree, which then produces more fruit. Similarly, DRIPs allow your dividends to grow into more shares, which then produce more dividends, and the cycle continues. DRIPs help your investments grow faster, and here's how. DRIPs work in a fairly straightforward way. Now let's dive into the mechanics of how a dividend reinvestment plan, or DRIP, operates. You see, when a company in which you've invested declares a dividend, something special happens with DRIP. Rather than receiving a cash payment directly into your account, the dividend is used to purchase additional shares in that same company. Imagine it like this. You're at a bakery, and instead of getting your change in coins, you're offered more pastries. Now who wouldn't want more sweet treats, right? This is the essence of DRIP. The dividends you earn are not given to you in cash. Instead, they're used to buy you more shares. But it gets even better. These additional shares are often bought at a discount, meaning you get more for your money than you would if you were buying shares on the open market. And what's more, these purchases are often free of brokerage fees. That's right, no extra charges eating into your returns. Now let's talk about the magic of compound growth. As the number of shares in your portfolio increases, so do your dividends. Because dividends are usually paid out as a fixed amount per share. So the more shares you have, the larger your dividends will be. This in turn buys you even more shares, and the cycle continues. Over time, this can lead to significant growth in your portfolio, all without you having to lift a finger. So, let's say you've invested in a company that has been consistently paying and growing its dividends. With DRIP, each dividend payment allows you to buy more shares, which entitles you to larger dividends, which then buy even more shares. It's a cycle of growth that can really add up over the years. So instead of a cash payout, you get more shares, which can potentially increase your earnings in the long run. By reinvesting your dividends, you're effectively putting your money to work, allowing it to grow and multiply. And in the world of investing, that's a sweet deal indeed. So what are the benefits of using DRIP for your investments? Now that's a question worth exploring. Firstly, let's talk about the power of compounding. This is the process where your earnings generate even more earnings. You see, when your dividends are reinvested, they purchase more shares, which then generate more dividends, and so on and so forth. It's like a snowball rolling down a hill, growing bigger and bigger with each rotation. Next up, let's discuss the potential for higher returns. With DRIP, you're essentially putting your dividends to work immediately, instead of having them sit idle in your account. This can lead to higher returns over time, as you're continuously growing your investment without lifting a finger. Now, on to the convenience of automatic reinvestment. With DRIP, your dividends are automatically reinvested back into the stock, without you having to do anything. It's a set-it-and-forget-it approach that's perfect for those who want to invest without the daily hassle. Lastly, there's the ability to purchase fractional shares. This means that every last cent of your dividend is put to work, even if it's not enough to buy a whole share. This ensures that none of your money is left on the sidelines. All these benefits make DRIP a powerful tool for investors looking to maximize their returns. DRIP is indeed a smart way to make your money work harder. Let's recap. It's a method where dividends are used to purchase more shares, effectively compounding your investments over time. This strategy offers tangible benefits like dollar-cost averaging and automatic reinvestment, making it a potentially lucrative addition to your financial toolkit. So, consider DRIP as a part of your investment strategy. Remember, with DRIP, your investments keep growing, even while you sleep.